Hi guys, I'm Becca from CY Mood. In today's video we will discuss interest rates, and we will see what negative interest rates are and how they work. What is a negative interest rate? A negative interest rate is a loan, granted by a financial entity, where you don't pay to take money but you get paid to access this loan. A borrower who is paid to take out a debt. So great. But what negative interests mean for the economy? Interest is the money you pay to the bank to borrow money for your work or family activities. Or it is the money you are credited by the bank to keep your funds in your bank account. Low interest rates are intended to encourage banks to increase lending and not keeping a lot of liquidity stored in their accounts, pushing customers to access these cheap loans. High interest rates are designed to push people to spend less and try to keep inflation under control by cooling the economy. The opposite is created by lowering rates. The European Central Bank started with negative rates in 2014 and the Central Bank of Japan started in 2016. With negative rates, banks will begin to lose profitability from money deposited in their customers' accounts. Negative interest means that deposit accounts and money stored in current accounts will be remunerated at zero or they will have to pay to keep money in their accounts in the bank. In this case, the bank may decide to absorb this cost for their client if they take other products from the bank such as insurance, mortgages, etc. It happened in Denmark that a bank applied a rate of -0.5%. Consumers are thus discouraged from keeping liquid money in their current accounts and are therefore pushed to spend it. This has an impact on the entire economic chain, both private and corporate. The costs for loans to the public will certainly be higher than those that the bank will have, on the other hand it is their business. In the case of negative interest decided by the central bank, it is not necessarily the case that consumers should also have negative interest on their loans. At the moment, we do not fully understand the real consequences of negative interest rates on the real economy, despite the fact that they seem a very good thing for Main Street people. Theoretically, low or even negative interest rates are used to drive the economy with more consumer spending, a greater propensity for indebtedness and a growth in consumption and inflation. With inflation, the growth of consumer prices, there is a loss of value of the currency of the country that is the victim, which means a greater possibility to sell their products abroad given their lower value at the exchange rate with competitors, another boost to the demand for goods and services. So good. If that happens, the countries that are now protagonists of this financial policy have had problems with chronic slow growth and therefore be in deflation. Deflation encourages banks and people not to spend their money. Deflation leads to the cycle more savings, less spending. Negative interest is seen as a way to discourage this cycle and indeed reverse it. Negative interests can have many negative effects on the economy and population. People may decide to hold their savings in physical currency, creating a bank run instead of keeping their cash in bank accounts and then paying the cost of the account. Financial bubbles are another effect. People could get into debt at an unsustainable level and this create a financial bubble, with all that entails. Do you remember our toxic assets? That means making risky investments with money that savers cannot afford to lose. In the event of a crash, the situation would be very problematic. The negative interests then hit savers and bond investors. Savings are no longer remunerated and bond yields go to zero. Risk is no longer properly remunerated, creating distortions in the market, which leads to increased risk in the investment portfolio to maintain the same level of remuneration. Think about how all pension funds and bond funds are affected. Companies take money in debt not to create new production lines or increase their workforce, but to buy back their shares, artificially increasing their value on the market. The banks are also affected, as this action greatly lowers their profits on loans and other products. Negative rates can be seen as paradoxical and controversial. Negative rates on various bonds lead to not placing the bonds on the market, since in a normal market nobody lends their money without having an economic return. On the contrary, we must mention the safe haven bonds have a low if not non-existent yield, but we are talking about bonds issued by countries considered safe. Thanks for following us and we'll see you on the next video. Thanks for watching. Please subscribe and share our video to spread our knowledge. And remember to check all the product made for you by the CY Mood team.